Good morning and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite, we have Bob Yager, who's a senior energy analyst over at Mizuho Americas. Bob, as always, thank you so much for joining us at MarketSite. And we're sitting at an interesting level here, oil at just about 3-month highs.
Yes, we did put in a 3-month high in this current session. This session has been running from Sunday on the holiday, extended holiday. And yes, we did trade to a high of 56.33. Market is bid on optimism around the trade talks. It's bid on OPEC production cuts. And we're also seeing an extension of the upside here on speculative buying. The spec position is at a 14-week high. So you do have the specs jumping and pushing also.
Right. Why do you think they're in there now, of all times?
Well, they're very good at, once you see that bottom that we had in December on the corresponding rebound, they will often jump in. And obviously it will start off as just kind of nibbling at the edges, but as it starts to gain momentum, they're in. And you start to get the correlations to the equity markets also, the S&P and the Dow. And they will try and find one of the weaker sectors, and they'll run with that. Even in equity names right now, the energy sector is the second best performing sector in the S&P 500.
All right, now what about, there's still a weaker demand picture, though. That has not gone away.
No, that has not gone away. Gasoline in particular, that has been really lagging as far as demand is concerned. It's a situation where, you know, we are at lower levels. Gasoline's about 20 cents lower than it was last year, so this corresponding correction in price has taken place. What we're seeing right now, what happens is, and this may actually serve as a support level for crude oil and for the products, is the refineries start to run really low at this time of year. It's neither driving season, and despite the fact that it's freezing cold out right now, it is not heating season either. We're going to ramp that down. We've already made all the heating oil we need. So at this time of year, right now, refineries are running at about 85%. That's a low number. That adjusts for demand. The refineries will adjust for demand. They won't make as much gasoline because there's enough in storage already. The gasoline storage number was an all-time record a couple weeks ago. And they adjust accordingly. They don't make as much. The problem with that is, and maybe that will put the end to this rally, is that you don't need as much crude oil at that point because you don't need as much gasoline. And it's yet to be seen, but this week could be a big number in the storage report.
Right, and then you would expect oil to trade lower.
That is correct. You'd get a pretty big storage number that would kill the golden goose here, crude oil.
Now, there's an interesting story, too, coming out of India and a deal it recently signed with the U.S., and that kind of goes back into the OPEC supply issue. That
is correct. India inked a $1.6 billion deal with the United States on Sunday. They're going to take a 1-year look at crude oil from the United States, and that's the first time for the relationship. So OPEC cuts production, and the United States steps into the void. That's the way it's going to be. The unpredictable reality with some of the OPEC countries, too, versus the rock-solid foundation here in the United States also makes the U.S. very attractive. So, yes, India is going to be a customer of the United States moving forward from here. And also at this time right now, a very interesting dynamic here in energy markets is WTI, U.S. crude oil, is about $10 cheaper than international benchmarks. So pricing-wise, it's also very attractive.
Because you would think logistically it would make sense for India to import from the Middle East.
Yes, it's closer, the whole thing. However, that $10 goes a long ways. So especially with recent expansion of the Panama Canal, it makes these kind of barrels much attractive to a company.
Will that spread tighten at all?
It's debatable. We have two dynamics moving against each other. This is the big part of the energy market right now. You have all-time record production here in the United States. Last week's EIA domestic production number was 11.9 million barrels. At the same time, you have barrels being taken off the market, first of all, voluntarily, second of all, versus sanctions in other parts, in OPEC. So the OPEC barrel forces international barrels higher, but overproduction here in the United States forces the U.S. barrel lower. And that Brent WTI widens as a result of that. At some point, it will find an equilibrium, but it has historically gone well past $10, which is only going to make the U.S. barrel more attractive.
Right.
Moving forward from here, I think what we're going to see, and this has been playing out in the weekly storage numbers too, you're going to see an increase in exports, you're going to see a decrease in imports into the United States. Last week's import number was the lowest since something like 1997. And the export number, we're just brand new to that. It was against the law to export barrels until rather recently, but we're consistently putting numbers out that are close to 3 million barrels a day or even above 3 million barrels a day. And the more long-term deals we ink with people like India, the more those are going to leave the United States.
It sounds like the days of $100+ per barrel are over.
That's going to be difficult,
for the most,
yes.
particularly with us exporting now.
Yes, I mean we have multiple OPEC countries that were bedrocks of the global oil system, basically taken off the market, and we're still trading at $55.
All right, Bob, thank you so much as always for joining us at MarketSite, and thank you for joining me throughout the week. I'm Jill Malandrino, Global